Welcome, everyone. Today, we are diving into one of the most powerful tools that traders use to identify key price levels and understand market behavior. That tool is called the volume profile. By the end of this discussion, you will have a much clearer idea of how to interpret the volume profile, and most importantly, you will be ready to use it to make more confident and informed trading decisions. So if you are curious about how this tool works and want to take your trading knowledge to the next level, stick around. We have a lot to cover, and I promise it will be worth your time. Before we dive into the details, imagine having a tool that allows you to see not only how price moves, but where traders are truly taking action. What if you could see the exact price levels that are attracting the most interest from both buyers and sellers? This is the power of the volume profile. Let us begin by understanding what exactly the volume profile is. Imagine looking at a chart that does more than just show the price. Instead, it tells you where the most buying and selling activity happened, right at specific price levels. This is what the volume profile does. It shows how much volume was traded at each price level over a certain period of time. This is different from the typical volume indicator that only tracks volume over time. By knowing where the highest trading volume took place, you can get a sense of where other traders have made their moves, and that can help you understand important levels in the market. Now, let us dive deeper into how the volume profile interacts with chart patterns. Chart patterns can be powerful tools when combined with the volume profile, as they help identify potential market turning points. Let us start by examining some common chart patterns and how they can be interpreted more effectively with the volume profile. For instance, when you see a double top or double bottom pattern forming at a high volume node, it can provide a strong signal of potential reversal. High volume areas often act as resistance or support, and if a chart pattern such as a double top forms at these levels, it suggests that the market is struggling to push past this point, and a reversal could be on the horizon. A double top forming at a high volume node implies that sellers are entering aggressively, preventing the price from moving higher. On the other hand, a double bottom at a high volume node shows buyers stepping in strongly, which could lead to a price reversal upwards. Paying close attention to how price interacts with the volume at these levels can give additional clues about the strength of these reversals. Another example is the head and shoulders pattern. If this pattern forms near a point of control or at the boundary of a value area, it can indicate a significant change in market direction. The head and shoulders pattern, combined with high volume in certain areas, provides a strong indication that the trend might be reversing. The left shoulder often forms at a key resistance point, and when volume decreases at the head, it suggests weakening buying pressure. This makes the subsequent right shoulder a critical zone to watch for a potential reversal. Likewise, an inverted head and shoulders pattern near a low volume node could suggest a potential breakout, as the low resistance in these areas may allow the price to move quickly in the new direction. Triangle patterns, such as ascending, descending, or symmetrical triangles, can also be better understood with the help of the volume profile. When a triangle pattern forms and the price is approaching a high volume node, it suggests that traders are waiting for confirmation before deciding on the next move. A breakout from the triangle with increased volume can signal that traders are accepting a new price level, making it an ideal opportunity to enter a trade. Ascending triangles near high volume nodes often indicate that buyers are testing the upper resistance level repeatedly, and a breakout with increased volume confirms that buying pressure is strong enough to push the price to new highs. Conversely, descending triangles forming near low volume nodes might break downward rapidly due to the lack of strong buying support. Wedges, both rising and falling, are also important to look for alongside the volume profile. If a rising wedge forms near a value area high with decreasing volume, it might be a sign that the upward movement is losing steam, and a reversal could occur soon. The decreasing volume suggests that fewer buyers are willing to push the price higher, indicating a weakening trend. Conversely, a falling wedge near the value area low, accompanied by increasing volume, could indicate that a bullish breakout is imminent. The increase in volume suggests more buyers are stepping in, making it more likely for the price to reverse upwards. Flags and pennants are continuation patterns that also benefit from volume profile analysis. If a flag forms after a strong move and the price remains near a high volume node, it shows that the market is consolidating at a significant level, and the next breakout might continue in the direction of the prior trend. By observing the volume behavior within the flag, traders can get more confidence about whether the trend will continue or if a reversal might occur. If the breakout from a bullish flag happens with strong volume near the value area high, it provides a strong signal that the trend is likely to continue. Conversely, if a bearish flag forms near a value area low and breaks downward with increased volume, it is a strong indicator of further downside movement. By combining classic chart patterns with volume profile analysis, you can better identify high probability setups. Volume profile gives you context that traditional price patterns alone cannot provide, helping you confirm whether a breakout, reversal, or continuation is likely to succeed. Paying attention to where these patterns form in relation to high volume nodes, low volume nodes, value areas, and points of control can give you a significant edge in reading the market effectively. Another example is the head and shoulders pattern. If this pattern forms near a point of control or at the boundary of a value area, it can indicate a significant change in market direction. The head and shoulders pattern, combined with high volume in certain areas, provides a strong indication that the trend might be reversing. Likewise, an inverted head and shoulders pattern near a low volume node could suggest a potential breakout, as the low resistance in these areas may allow the price to move quickly in the new direction. Triangle patterns, such as ascending, descending, or symmetrical triangles, can also be better understood with the help of the volume profile. When a triangle pattern forms and the price is approaching a high volume node, it suggests that traders are waiting for confirmation before deciding on the next move. A breakout from the triangle with increased volume can signal that traders are accepting a new price level, making it an ideal opportunity to enter a trade. Wedges, both rising and falling, are also important to look for alongside the volume profile. If a rising wedge forms near a value area high with decreasing volume, it might be a sign that the upward movement is losing steam and a reversal could occur soon. Conversely, a falling wedge near the value area low, accompanied by increasing volume, could indicate that a bullish breakout is imminent. Flags and pennants are continuation patterns that also benefit from volume profile analysis. If a flag forms after a strong move and the price remains near a high volume node, it shows that the market is consolidating at a significant level, and the next breakout might continue in the direction of the prior trend. By observing the volume behavior within the flag, traders can get more confidence about whether the trend will continue or if a reversal might occur. By combining classic chart patterns with volume profile analysis, you can better identify high probability setups. Volume profile gives you context that traditional price patterns alone cannot provide, helping you confirm whether a breakout, reversal, or continuation is likely to succeed. For instance, if you see a lot of trading activity around a certain price, it is likely that this level is very important. It could be a strong support or resistance. Traders are paying attention to it. It gives us clues about where the price might struggle to move past or where it might bounce back. And here is the best part. Understanding these levels can make you a better trader. It can help you decide when to buy or sell, where to put your stop losses, and even how to set your profit targets. Does that sound useful? It should, because this is where you can really start to read the market like a seasoned trader. Let us break down some of the key components of the volume profile. You will hear me talk about the point of control, also called the POC, quite a bit. This is the price level where the most volume was traded. You can think of the point of control like a magnet. Price tends to be drawn to it because it is where buyers and sellers are most active. Traders often look to this level to find opportunities because price can move away and then come back to test this level, giving you a potential trade setup. Next, let us talk about the value area. This is the range where about 70% of the volume was traded. Within the value area, you have two important boundaries. One is called the value area high, and the other is the value area low. Together, they define the upper and lower parts of the value area. The value area shows us where most of the trading happened, and often price tends to stay in this area unless something big happens to push it out. If price starts moving above the value area high, it could mean that it is overbought. If it is below the value area low, it might be oversold. It is helpful to know where these areas are so you can plan your trades accordingly. Now let us expand further on how specific chart patterns can interact with the value area to provide strong trading signals. For example, a double top forming just above the value area high can indicate that the market has reached an overbought state and is likely to reverse. This reversal could lead the price back down toward the value area, providing a potential short selling opportunity. On the flip side, if a double bottom forms just below the value area low, it suggests that the price might be oversold, and a move back up into the value area could be on the horizon, signaling a buying opportunity. Another powerful pattern is the head and shoulders. If this pattern forms at or slightly above the value area high, it can indicate that the trend is exhausted and a reversal might be imminent. Traders can use this information to look for short entries as the right shoulder forms, with an initial target at the point of control or within the value area. Similarly, an inverted head and shoulders pattern forming around the value area low could indicate a bullish reversal, and traders might look to enter long positions as the price breaks above the neckline, aiming for targets at the value area high or beyond. Triangles are also significant when analyzed in relation to the value area. If an ascending triangle forms near the value area high, it can suggest that buyers are testing the upper boundary, trying to push through to a new level. A breakout with strong volume could lead to a sustained upward move. Conversely, if a descending triangle forms near the value area low, it might indicate that sellers are pressing to break below, and a downside breakout could mean a continuation of the bearish trend. The volume profile can help validate these breakouts by showing whether there is enough activity to support the move. Flags and pennants often form during periods of consolidation within the value area after a strong trending move. If a bullish flag forms within the value area and breaks out with increasing volume, It can signal that the trend is ready to continue upward, particularly if the breakout happens near the value area high. A bearish flag forming near the value area low and breaking downward can be an indicator of further downside movement. Monitoring the volume within these patterns is key, as it helps to distinguish between genuine breakouts and false moves. Wedges, particularly falling and rising wedges, can also offer insight when they form near value area boundaries. A falling wedge forming just below the value area low with increasing volume could signal a bullish reversal, as it indicates that buyers are stepping in. Conversely, a rising wedge forming near the value area high with decreasing volume could suggest that the bullish trend is weakening, and a bearish reversal might soon occur. By combining the concepts of chart patterns and the value area from the volume profile, traders gain a richer context for making trading decisions. It is not only about recognizing the patterns, but also understanding where they form in relation to key volume levels. This approach helps to provide stronger signals, reduce false entries, and ultimately improve the quality of your trades. Now, let us get into some of the other terms you need to know to use the volume profile effectively. High volume nodes are areas where a lot of trading occurred. These areas are important because they are often strong levels of support or resistance. When price comes back to these levels, there is a good chance it will either stall or bounce. On the other hand, low volume nodes are the opposite. These are price levels where very little trading took place. Price tends to move quickly through these areas because there is not much to hold it up or push it back. So if you are watching the market and price enters a low volume node, it could be a sign that things will start moving faster. This is useful to know if you are looking for breakout trades or opportunities to catch a quick move. One strategy to keep in mind when you are trading with the volume profile is to look for opportunities around the point of control. Since the POC often acts like a magnet, price can return to it. You could look to enter a trade when price is near the POC and moving away, or when it comes back to test that level. For example, if the price breaks away from the POC with strong volume, it could indicate a new trend is forming, providing an entry opportunity. Similarly, if the price returns to test the POC, a successful test could mean a good point to enter a trade in the direction of the trend. Another thing to watch is how the price behaves around the value area boundaries. When price breaks above the value area high or drops below the value area low, it signals that traders are starting to accept a new price level. This could be the beginning of a bigger move, and you could use this information to plan your trades. For instance, a break above the value area high with strong volume suggests the market is willing to accept higher prices, making it a potential opportunity for a long trade. On the other hand, a drop below the value area low could indicate a bearish move, providing a possible shorting opportunity. It is also helpful to recognize how price interacts with high volume nodes and low volume nodes during these breakouts. When a breakout occurs into an area with a low volume node, price tends to move quickly because there is less resistance. This is often a good opportunity to capture a quick move. Conversely, if a breakout occurs into a high volume node, it might indicate that the price will face resistance or support, and you should look for consolidation before continuation. Of course, if you see a breakout, make sure there is enough volume behind it. Breakouts on low volume are less reliable and might not stick. Always pay attention to the volume profile accompanying the breakout, as this will help confirm whether the move has strength behind it or if it could be a false breakout. Reversals are another great opportunity with the volume profile. If the price moves up to the value area high with a lot of volume but cannot break through, that might be a sign that a reversal is coming. It could mean that traders are not ready to accept higher prices, and the price might start moving back down toward the value area. You could also look for divergence between price and volume. For example, if the price keeps moving up but the volume starts decreasing, it means that fewer traders are participating in that move. That could be a clue that the trend is weakening and could reverse soon. Another key thing you can do with the volume profile is to combine it with other indicators. Moving averages are a great way to confirm what you see with the volume profile. For example, if the price is trading above a moving average and also near the value area high, it is a good signal that the uptrend is still strong. You can also use the Relative Strength Index, or RSI, to identify overbought or oversold conditions. Let us say that price is near the value area high, and the RSI is showing that the market is overbought. That could be a signal to look for a reversal. Another great combination is to use Fibonacci retracement levels. If these levels line up with your volume profile levels, it makes those areas even stronger. It is really important to think about risk management when trading with the volume profile. You want to use key volume levels like the POC or value area boundaries to place your stop-loss orders. If the price moves past these levels, it could mean that the trend is moving against you. Proper risk management helps minimize losses and protect your capital, which is crucial for long-term success in trading. Another tip is to adjust your position size based on volume. If you are trading near a high volume node, you might want to take a larger position because these levels can offer strong support or resistance. High volume nodes represent areas where many traders have previously entered or exited trades, which means that these levels are more stable, providing you with a higher probability setup. When trading around low volume nodes, you might want to use a smaller position size because the price can move more quickly and be more unpredictable. Low volume nodes indicate areas of lower trading activity, meaning there is less support or resistance to hold the price. As a result, the price can move swiftly through these zones, and it is important to adjust your risk accordingly to avoid large, unexpected losses. There are also some common mistakes to avoid when using the volume profile. One big mistake is to ignore the low volume nodes. These areas can signal quick price moves, so you need to be aware of them. Another mistake is overtrading around the point of control. Price can bounce back and forth around this level without really making a strong move, and if you are not careful, you could get caught in a lot of false signals. The best thing to do is wait for a clear signal before entering a trade. And always remember, do not rely only on the volume profile. It is a great tool, but it works best when you combine it with other indicators like moving averages or trend lines. To sum up, the volume profile is a fantastic tool for identifying where the most trading activity took place. It can help you spot key levels of support and resistance, identify breakouts and reversals, and even help you manage your trades more effectively. Start by adding the volume profile to your chart and focusing on the point of control, the value area, and the volume nodes. Combine it with other indicators to make your analysis stronger and improve your trading decisions. Trading takes practice, and the more you work with tools like the volume profile, the better you will get at spotting opportunities. Stay curious, keep learning, and never stop practicing. There is always something new to learn, and the more you know, the more confident you will be in making your trades. If you have questions or if something is unclear, feel free to ask. I am here to help you understand and grow in your trading journey.